So this is where we're at with valuation. Just to kind of recap quickly what we were doing yesterday. I mean, the point and then how we introduced this yesterday was trying to figure out what's the purpose of valuation, and valuation can have several different uses, but I mean, really, it's all about how much is this company worth, right? How should we pay for this company? And we spoke about the three core methodologies, but really the framework and the mindset is the trickiest thing, because valuation is just a certain way of thinking. And I gave you the practitioner side of it. And there's really two sides of value, right? There's book value and there's market value. And book value is what's written up on the GAAP papers based on either appraisal values or purchase values, net of the liabilities associated directly with those assets. Or market value is based on the most recent price paid, or the stock price. And the difference between book value and market value could help us determine different types of valuations. Right? Market value is more current. Book value is based on what's been accumulating over time on your balance sheet in the company. And all of these different underlying drivers of value, we would interpret into multiples to help give us a range that would represent how much our company could be worth. And so when I say multiples, first of all, I'm talking about there are market value multiples and there are enterprise value multiples, right? Market value multiples are based on the stock price times the shares outstanding or the market capitalization. Enterprise value multiples is the market value plus the net debt. So the first question we asked yesterday, which is a popular investment banking interview question, is why do you add back net debt to market value to get to enterprise value? What's the purpose? And we drew the analysis on the board, and it resulted in what we want to add back net debt, because essentially what that approach is a value of the core operating assets of the business. So in valuation, it's important to assess the core operating asset, the core value of the operating assets of the business. I mean, eliminating the capital structure. Right? So we take the market cap and we add back the net debt. Right? It eliminates the capital structure. It eliminates the impact of capital structure. So that's what we spoke about yesterday. And so we have multiples that are based on market value or enterprise value. And these multiples are utilized to help compare with other businesses. Right? You can't just take market value or enterprise value as absolute numbers, because companies are different sizes. So you compare them to the underlying performance of the business. So market value as an absolute number might not have meaning when comparing to other businesses, but the market cap being in relation to the net income being produced, or the PE, is something that we can compare, and we can use as comparison. So multiples are used to compare approximate values between your company and other companies that are similar in size and product and scale and scope. Geographic scope. And so there are market value multiples and enterprise value multiples. Market value multiples compare operating or book value metrics after lenders have been paid, net metrics. So you compare market cap to earnings, you can compare market cap to book value or shareholders' equity, but you cannot compare market cap to EBITDA, right? EBITDA is before interest, before debt, before capital structure. Market cap is after. So in order to use EBITDA as a comparative metric, we need to find some sort of equivalent that's before interest or before debt. And that's how we come up with enterprise value. Enterprise value is market cap before debt. So with enterprise value, we can compare to units of measure that are before interest or before capital structure. So we can compare enterprise value to EBIT or to EBITDA or to sales or to total assets. Right? And so I'm just recapping what we spent all day yesterday on. And so based on these multiples, there are three core methods of valuing businesses. And we spoke about them. We spoke about the benefits and drawbacks of each, AJ? Yes.
Sorry, did you say EV does not incorporate debt?
Yeah. It's not incorporate debt. It is before eliminating capital structure.
Sorry, can you move back to the slide? Isn't it where EV is market cap plus net debt?
Yeah.
That's wrong, right?
That's right. You are wiping it out of the capital structure. So sorry. Wait, did I understand your question? What's the question?
Sorry.
I want to make sure.
You said EV is not including debt.
Yeah.
But doesn't that just say like our EV is our capital structure?
You're adding it back. You are eliminating it from the capital structure. Right? It's just like EBT plus interest, EBIT, EBITDA.
Oh, yes. Okay.
Yeah, you're adding it back. You're effectively eliminating it. You're eliminating the impacts from the capital structure. Just like total liabilities, shareholders' equity plus liabilities equals total assets. Total assets does not include the liabilities. Okay, I see your question. Gotcha.
So in that case, then you say that way you kind of eliminate that since one company had lots of debt.
Yes, exactly. That's exactly right. So the three core methods we mentioned are utilized to value business, and they all have kind of their own unique and major flaws, but they all come from unique and separate approaches of valuation. So the point is, if we run all these three analyses and they all come with a similar valuation range, that might be a starting point for valuation negotiations, right? One most common method is the comparable company analysis, which is comparing these multiples that we just discussed, your company versus several others, 6, 12, and you want to look for companies that are similar in product, scope, scale, and you run these multiples. We'll go through a comparable company analysis tomorrow and Thursday. And you compare the multiples of your business versus those, right? So if your comparable company, if the companies that are comparable to you have a multiple range, let's say of 5 to 7 EV to EBITDA, and your company is much higher, 10, it could mean that your company is overvalued. If yours is much lower, like 2, for example, it could mean that your company is undervalued. So comparable companies is a good way to determine what the approximate value is. The benefit of a comparable company analysis is it's very current. It's the only analysis truly based on, fully based on the stock price of the year before, the day before, right? It's as current an analysis as you can get. Drawback is it might be difficult to find comparables, or if the whole industry is overvalued or undervalued, your analysis won't work in this example. So that's why you would cross-check this with other methods to help determine and flush out the flaws. Next, again, we're just recapping, is the precedent transaction analysis. This compares multiples, but not market multiples, purchase multiples. So purchase multiples, similar formula, PE, enterprise value to EBITDA, but PE is not based on the current stock price. It's based on the price paid for a business. So in a precedent transaction analysis, you'd compare, if you're going to look at the value of your business, you'd look at other similar companies and prices people have paid for those businesses, prices on a multiple basis. These companies sell for 2 times revenue. They sell for 7 times EBITDA. So that means that your company could be worth 7 times EBITDA. Right? So the benefit of a precedent transaction analysis is it includes a premium. Right? In order to buy a business, you have to pay a control premium to convince shareholders to give you their shares. So that could be a benefit. You can determine, if you're really looking at this from an M&A perspective, you can really determine how much premium is needed to pay for this business. Drawback is very difficult to get to find like transactions, especially in this market environment. If you find those transactions, it's very difficult to get enough underlying data to create these multiples. And also, if you do, this data is a historical analysis. It's dated. So that's another problem. Even if you find information, it might have been a year ago. This is today might be a different market environment. So it might not always hold. These numbers might not always hold as true based on transactions. Third, discounted cash flow, known as the most technical of the three because it's based on projected cash flows. This is what we're building our model towards. It is projecting the first X years of cash flow, discounting back to present value, and then coming up with some value of the company after year X to infinity. And so the advantage is the most technical. The disadvantage is the value of the business after the last projected cash flow out to infinity is a little bit more vague. That's the drawback. And so we started talking about the discounted cash flow analysis. And the first thing to note is what we do is we don't take total cash produced by the business. We take unlevered free cash. Why unlevered free cash? What does that mean? That's cash eliminating unlevered, eliminating leverage, eliminating interest, eliminating debt, and eliminating the rest of the capital structure, eliminating equity, eliminating distributions, anything that's one-off or not core to the operations. Why? Because we want cash that's directly from the operations, the cash that would effectively produce more cash in the future. And so what I'm trying to illustrate here is the unlevered free cash flow is really just a simplification of the standard cash flow statement. Here's a cash flow statement that has cash from operating activities, net income, D&A, deferred taxes, working capital. Here's cash from investing activities, which contains CapEx, other investing items, cash from financing activities, which contains cash from debts, cash from equity, and distributions. And to get unlevered free cash flow, you first want to wipe out the line items related to leverage, the line items related to equity. Basically, every single financing activity line item is wiped out. You also want to wipe out anything that's kind of other, related to M&A, things that aren't core to operations. So we wiped out basically everything in the investing activities except for CapEx. CapEx is seen as core to operations. And what does that leave us with? That leaves us with net income plus D&A, change in deferred taxes, non-cash items, working capital, CapEx. But to get this to be truly unlevered, we need to add back after-tax interest expense as part of a portion of net income. So once you add back all those line items, you get to unlevered free cash flow. But then we said, a lot of times in a model, you don't start with net income for unlevered free cash flow, you start with EBIT. Right? Why? Why build all the way down to net income when a lot of these line items will be adjusted out anyway? So EBIT's on the top, it's easier to project to. You don't have to build the whole statement. If you're starting with EBIT, you make the same core adjustments, D&A, deferred taxes, some other non-cash items, working capital, CapEx. But you don't need to add back after-tax interest because it's already before after-tax interest. However, EBIT is before taxes. Net income is after taxes. So if you're starting with EBIT, we need to make an adjustment to taxes. We need to take out taxes. We take out taxes by, we would not take the taxes from the income statement. We calculate taxes as EBIT times tax rate. We cannot take the taxes from the income statement because taxes from the income statement contains the impact of interest, and we do not want the impact of interest. So if you did this side by side, you'd get the same number. So we calculate unlevered free cash flow. We project it out for X number of years, however long you've built your model, 5 years, 7 years, 3 years, and you discount that back to present value using some discount rate. We didn't talk about discount rates yet. We assume 10%. And that gives us the current value of the business for the first X years. In Walmart, we did 5. Now we need to come up with an assumption for the value of the business after year 5. And there's 2 popular methods of doing it. One is the multiple method, taking the last projected year's metric, some metric, EBIT, EBITDA, net income, applying a multiple to it. That's one way to do it. And that gives you a value of the business at that year. Discount that back to present value. Or there's the perpetuity method. The perpetuity method is just a mathematical series. And the formula for the perpetuity is the last year's cash flow times 1 minus G, where G is some basic rate of growth in cash, gross domestic product, inflation, divided by R minus G, where R is the weighted average cost of capital. And that should give you the value of the sum of this converging infinite series, and you would discount that back to present value. So what's the benefit of one versus the other? Let's do it. I always recommend doing both and comparing to try to cross-check. And so in the model, we had started by already laying out all the pieces for our unlevered free cash flow. We discounted back. We use the end of year convention. Remember the difference between the end of year and mid-year convention? The end of year convention is one common way of discounting, meaning we discount the cash flow in year one by one full year, year two by two, year three by three. Some people like to do the mid-year convention, which discounts the first year's cash flow by a half, second year by 1.5, third year by 2.5, and their thought process is, well, if you're discounting by one full year, you're implying that the cash is coming in one lump sum. And it might not come in one lump sum. It might trickle in over time, and if it does, discounting by a half a year kind of averages the flows in a way. I took the end of year convention. Note the discount rate. The discount formula is the cash flow divided by 1 plus the rate to the power of the number of years. We just use 10% for now. We'll adjust this. And then we have terminal value. And there's two ways to calculate terminal value. One is the multiple method. Let's look at the multiple method. Let's take the final year EBITDA is most common. I'm going to take the final year EBITDA by taking EBIT plus depreciation. And applying a multiple. So the question is, where can you get that multiple? Where do you think? Yep.
We want to just look at prior years. So I'm not making an assumption that there's going to be growth in the EBITDA multiple. Just think that we'll see appreciation through improvements or growth.
Yeah, okay. I mean, there's a couple ways to do it. One, you can look at the comps. We haven't done the comps yet. Get an average range. Two, you could just look at the most recent multiple, and we'll talk more about multiples and multiple expansion in the LBO course. But remember, this is a practitioner's method as opposed to the textbook perpetuity method. And the idea with the EBITDA method, the implication is that in the final year after year 5, the value of the business to us is the value that we can sell the company for. So how much can you really sell the company for? And in a leveraged buyout analysis, where this is a more popular exit, where you often base an exit on a multiple, we would assume, to be conservative, that the current multiple will be the sale multiple. And in reality, you would hope that that multiple will expand over time, will grow over time. But conservatively, we would assume this year's multiple. But we would hope that EBITDA is growing such that even though you're selling at the same multiple as today, there would be a positive sale. You could also argue that the multiple might decline. If your company's overvalued, it may. So you do want to definitely cross-check this multiple with your comps. But if your comps happen to be higher, I don't know if I'd necessarily assume multiple expansion. So let's first just take the current multiple. Okay, so we're going to calculate the current multiple. And what I'm going to do is, so we're going to have to take the current enterprise value divided by the current EBITDA. And to not be too redundant, to calculate enterprise value, we need market cap. And if you see on the right, we didn't talk about cost of capital yet, but I'm just thinking ahead. There is a place here to calculate equity value. So I don't want to calculate it in two places. So let me calculate it here so I can use this. So the stock price we already have, right? The stock price we did when calculating the stock options way back on the income statement, 7382. So let's use 7382. I'm going to multiply by the shares outstanding. And I want to use the most current possible. And I want to do diluted shares outstanding. So we kind of calculated all that for 2013. Even though we used 2013 for the projected year, don't get confused. I'm going to basically do a 2012 metric, but I want to do it as of today. Okay, so the equity value is the product of the two. So $248 billion. Make sure I'm matching in the book. $248 billion. Okay, yep. And then I'm going to need to add to the equity value the net debt. So first I'm going to pull in the debt for 2012. I'm going to pull in the total debt. And again, really this box is reserved for the weighted average cost of capital, but I don't want to be linking in the same information in two different places. So let me just, I know that this is we're going to need the total debt here for our WACC calculation later. Let me pull in the total debt now so I can use it for our multiple calculation. And the total debt's going to come in from the balance sheet. And in 2012, I'm going to take total debt as long-term debt plus capital lease obligations plus capital leases due within 1 year plus long-term debt due within 1 year plus there should be a short-term debt. There's 5 pieces. Yeah.
Is it wrong to use the latest stock price, but use the debt of the year end? So
I don't understand. I'm sorry.
if you calculate the equity value, you use the latest stock price,
Mm-hmm.
the latest shares outstanding. You only have information of debt outstanding of the year end. Wrong to combine those two.
I think in this case there was like a 15-day difference. Is that your question?
Yeah.
Sorry. Yeah, I mean you definitely want as current metrics as possible. You want as current metrics as possible. You don't want projections. We could do a projected metric, but we're trying to do it as current as possible. So I could have pulled out quarterly reports to adjust this even further, and we do for the comps. This was January 31st versus I think February 12th was the stock price. I don't remember. You want it as current as possible. Okay, that's the debt. Total debt, 53427. Okay, and what I'm going to do here, I didn't do it in the book, but I'm going to add enterprise value. Just so it's a little bit cleaner. And enterprise value is market cap plus net debt plus potentially other obligations. Remember we drew out the whole enterprise value formula yesterday. Right, so we're going to have less cash, right, net debt. So we're going to have equity value plus debt plus there are other obligations we're going to put in there, which will be non-controlling interests. Go in there. Plus the redeemable portion. Okay. I did capital leases already, right? Yep. Minus cash. Got it?
Minus what was the last one? Minus
Cash. So to get enterprise value, we took market value plus all the debts plus non-controlling interest minus cash. And I think I gave you the full, in the book, definition of market cap, right? If you go through the reading. I don't think you got to that in yesterday's reading, but obviously we did it yesterday in class, but yes. Short-term debts, long-term debts, current portion of long-term debts, capital lease obligations, preferred securities, non-controlling interests, other non-operating liabilities, including unallocated pension. 280 kind of tries to cover all the components that might go into enterprise value and why. Okay, that gives us 179.6. We will divide that by EBITDA to get our multiple. So our implied multiple is going to be enterprise value divided by 2012 EBITDA. Okay. 8.7. Yes. Did I do that right? Why is the EBITDA different in the book? The EBITDA is different in the book. Are we running a different scenario here? I gotta take a look at why this is different than in the book. 30582. This just this last EBITDA is different. Oh, 65432. Just make sure your 2017 revenue is a 2% growth. I don't know why I put 1. Yep, 2017 revenue growth was 2%. I just scaled it down evenly by 1% each. You make that change. There we go. Okay. So yes.
So isn't it the fact that we're going to use the same stock price or like the most recent stock price and comparing that to last year's EBITDA? Isn't that going to throw off that multiple? Because you're comparing last year's data set to the current stock price, which could reflect anything else that came out between.
No, well, in comps you do that, right? You don't go to historical stock price. The numerator is always current.
Okay.
As long as the denominators are consistent amongst the companies that you're comparing.
Gotcha. Okay.
You wouldn't go back with the numerator. Numerator is always as current as you can. Okay. Terminal value, we multiply now. Multiply to get the terminal value. And so that's the idea here is if we were to sell the company in 2017, we should sell it for $362 billion. But we have to discount this back to present value. And we discount the EBITDA method back a full 5 years. The multiple method, you'd always use end of year convention. You never use mid-year convention. Even if we did mid-year convention for these cash flows, you would still do end of year convention for the EBITDA method. Why? Did we say yesterday? How did we explain that? Nobody remembers? Yes?
Would that be because it incorporates the balance sheet items?
Mm-mm. And yet the perpetuity method, you would use mid-year. Any thoughts on why? Remember the idea? You had something? No? Yes?
It has something to do with that because because you're using EBITDA and that's the end of year figure. Nothing to do with it.
Because you're what?
EBITDA is the end of year figure.
Not necessarily, because it's the same figure up here where we discount. The idea is here because the implication is we are selling this in one lump sum. We will get the cash in one lump sum. Right? The point of the mid-year convention, the point of switching to the mid-year convention, if you were to choose to do so, is the belief that this cash is not coming in at the end of the year. It's coming in slowly over time. Regardless of that, the idea of the EBITDA method or the multiple method is always you are selling the business in one lump sum, you're getting the cash in one lump sum. Okay. So we will discount this. We discount this by in F24 equal to terminal value divided by 1 plus the rate to the power of 5 full years. Okay, 224,881.7. Okay. And we want to now cross-check with the perpetuity method.
Oh, can you go back to the formula for a second?
Yep. Got it? Okay. Perpetuity method starts with the last reported unlevered free cash flow. I mean, the last calculated, not the discounted. A lot of people make that mistake in the second test. It's the unlevered free cash flow. Growth rate gets tricky. A lot of people say you might read in books 3 to 4%. I think it's high for this market. Let's start with 1%. I forgot what I did in the book. I did 1? Okay. We'll show, I will explain how to step back and think about and tweak the assumptions. And the terminal value, we would use this perpetuity formula. Right? It's the unlevered free cash flow times, in parentheses, 1 plus that growth, divided by WACC minus that growth. You have to memorize that formula. Okay, so it's going to be equal to unlevered free cash flow times 1 plus the growth divided by, in parentheses, WACC minus the growth. Take a look at the formula. So F26 times, in brackets, 1 plus F27 divided by F17 minus F27. And that will give you 183 billion. And that you want to discount back. You guys get that formula? Okay. By taking the terminal value divided by 1 plus the growth rate, the discount rate, to the number of years. Discount that back. So we have quite a difference between the EBITDA method and the perpetuity method. So usually I would say that that's a concern. It needs to be explained. But there's a good reason. The good reason is because we made up the discount rate. We got to calculate the discount rate. Okay. Okay, so let's just fill out this box underneath. Let's assume that the discount rate is correct. This is not the value of the business. This is just the terminal value. How do we use this to get the actual value of the business of the company? What's the next step? Gotta add it. Absolutely. So down here, this is where we lay out side by side the value based on the EBITDA method versus the value based on the perpetuity method. So first it asks for, let's do the EBITDA method first. What is the total present value of all cash flows? That's this 59518. Then it says, what's the present value of the terminal value? Meaning in this case, the EBITDA method terminal value. And you add to get the total enterprise value.
Did you get the present value? No one, the TT4. Oh, I see.
Mm-hmm. So that's the value, and that's the enterprise value of the business. It's also helpful to convert that into the implied equity value and the applied value per share. How do we get the equity value? How do you go from enterprise to equity value? We need to subtract net debt. We're going backwards now. Now we're back calculating. What's the net debt? Well, I guess we're going to end up calculating it twice. We have total debt of 53427. To get from total debt to net debt, we got to add the minority interests and subtract out the cash. So we're going to add to this, going to the balance sheet. We're going to add non-controlling interests plus the redeemable non-controlling interests minus cash. So make sure you're getting the 51727. Did I have that there? No. You guys have that? So I just took the total debt plus, we did this before for the multiple, plus non-controlling interests plus redeemable non-controlling interests minus cash.
What's the difference between
Redeemable, the company has the right to call on it. They can buy it out.
Would that be clarified with the 10K?
Yeah, they talk about it.
Thank you.
Yep.
So anytime they announce like a buyback, it's from that specific pool, they can't get.
No, you can negotiate with the minority interest or non-controlling interest investor on the side, but then it becomes an M&A activity. Yep. And we'll get into that in M&A. Okay, so the equity value you subtract, right? 284 minus 51, it's 232. Equity value. And then to get to from equity value to the implied share price based on our analysis, we need to divide by the number of shares, and we pulled in the number of shares. We need the most current diluted number of shares, and we divide. So we are estimating the company to be trading at $69 a share. This will change. Our discounted cash flow is off. I mean, our discount rate is off. So I did this a little quickly, but this is just adding, subtracting, dividing. Bless you. Okay. And we do the same thing for the perpetuity method. Total present value of cash flows, 59518. Terminal value, the 113. You add. See, this is much slower. This is what you want to compare. Why? There's either an explainable reason or something's wrong with one of your assumptions. So we'll analyze that tomorrow. Let's just get the whack in order. Net debt. I'm not gonna recalculate. I'm gonna pull it in from the left. And then you can subtract to get from that to equity value. Get the shares. and divide. So we're saying right now that the company should be around 69 to 36. This is very low. Something's wrong here. Our whack is off. So we'll look at that. How is it off? Why? We'll look at that. Let me save this. Any questions? So tomorrow we're going to tweak this a little bit. We'll talk about the weighted average cost of capital, how it works, what it means, and then we'll start getting into comps.